I'll jump in anywhere. I'll go on the end.
Just testing? Okay, amazing. Well, guys, you're in for a treat because you've got some amazing panelists, and not only are they great miners and financiers, but they're also great thinkers, so I think it'll be quite interesting. And I've also got some kind of decent questions, so should be good. Just bear with me, I'll get that in. Technology, huh? Okay, let's start with you, Frank.
Thanks.
So gold has had like a spectacular run, right? Which you've previously linked it to a shift in the global monetary system. So what role do you see now for the global monetary system?
Yeah, you're right. It's had a spectacular run. The amazing thing is that most investors have been oblivious to this 40% run just this year alone. It almost feels like a gold rush, except without the saloon girls and the champagne. But and I get a real kick out of the pundits on the CNBCs of this world trying to explain the run-up in gold in U.S.-centric terms. You know, job numbers, Fed signaling, the economy, whatever, and you feel like saying to them, this is not about you, so get over yourself, because it's what's happening is happening outside of America, and there's a tectonic shift taking place in the global monetary system that I don't think a lot of people have clued into yet. I've been talking about this for a number of years. I've seen it coming, and I think if you just connect the dots of what's happening out there, you'll get a picture of where this is headed. And by connecting the dots, I mean, you have to look at first and foremost that there's a de-dollarization movement taking place. So, you know, central banks around the world are either pausing their purchases of U.S. treasuries or mostly outright selling those treasuries. So that's taking place. You've got 69 countries in an advanced phase of developing central bank digital currencies, and another 44 countries that are in the research stage. And as part of that, you got the M-Bridge project, which started a number of years ago between China, Hong Kong, Thailand, and the UAE, and Saudi Arabia's just joined recently. This was in partnership with the Bank of International Settlements, although they recently backed out of the program, and I suspect there was a lot of pressure from the United States to do that. And the last dot is that central banks around the world have been on a 15-year buying spree of gold, and now at an accelerating rate. And you know, last year I think they accounted for 30% of production, and it doesn't look like that's going to stop. That's going to continue. And I think that all of that, you put all of that together, and you get a clue of what's happening here. There's going to be a change in the monetary system. I don't know how long it's going to take, and I'm not even sure what it's going to look like. They've talked about a BRICS currency. I think, yeah, maybe someday, but not in the short term. They've, you know, obviously China's trying to internationalize the yuan. There's talk about a petro yuan, and perhaps, you know, eventually they'll be able to convert unwanted foreigners will be able to convert their unwanted yuans into gold on the Shanghai Futures Exchange, and you know, and there's a possibility that they will back currencies with some percentage in gold, 20 to 40%, like they did a century ago. But I think the one that is the most obvious is the M-Bridge project, which is a central bank to central bank settlement system for local currencies. And I think if you think about the bills of exchange that were circulating around Europe starting in the Middle Ages, it's similar to that. So the idea is, and this is my theory, okay? I'm not sure it's going to, but it's so simple that if you have two countries with bilateral trade agreements in local currencies using central bank digital currencies, as in the M-Bridge project, they can trade amongst each other, and if there's a deficit in unwanted currency, on certain periods, you settle that with gold. And that's why I think there's so much gold being purchased. Gold will play a role. I don't know what it's going to look like, but I am certain it's going to play a role, and that's going to mean a much higher gold price.
Frank, that's a strong start. Ronnie, up to you. Now, this year you wrote a paper with your partner, Mac Valek, called The New Gold Playbook, in which you talk about shift in geopolitical, the global monetary systems. Can you just explain to us what are the changes you're seeing taking place in the current gold market and like the new kind of gold game, as you called it?
Well, it's actually not a paper. It's a book. It's 450 pages. So quite a lot of trees had to die. Sorry about that. But the thing is, we sat together with the team, and there's like 20 people working on the report at the moment, and we said, okay, well, actually, we're seeing outflows from the gold ETFs. So we've seen more than 1,000 tons of gold being actually sold by the ETFs, although the gold price has risen. And then, and this is probably the most significant driver for gold, we've seen strongly rising real interest rates. And we wrote like 4,000 pages of research about gold, and I think we know a little bit about gold. We don't get it all the time, but I think if there's just one driver for gold, it would be the direction and the momentum of real interest rates. So falling real interest rates are a positive environment for gold, and rising real interest rates are a negative environment for gold, a headwind. Now, we've seen real interest rates actually exploding. We went from deeply negative to let's say, plus 3% positive real rates. And still the price of gold has made new all-time highs. So we said, okay, what's going on in the market? So we said, okay, something has changed in the gold market, and this is why we made the analogy with the playbook. So we said the new gold playbook basically means that, first of all, the marginal gold buyer is in emerging markets. I think people tend to forget, and Frank already said that briefly, that the majority of physical gold demand is now coming from emerging markets. Jewelry demand, that's almost 2/3 of physical demand, just coming from China, India, and the Middle East. When it comes to physical investment demand, it's 52, 53% just coming from China, India, and the Middle East. But here in the Western world, gold is still being regarded as something like, you just buy if you're extremely negative on everything, if you expect a recession, if you expect a hyperinflation, civil war, whatever. But I think, I think Frank Holmes called it the love trade, is now really much, much more important for gold than this so-called fear trade. So this is the first driver for this new gold playbook. And the second one is that actually I think that the fact that also what Frank said before, I think gold is making some sort of a heel turn. We borrowed that term from the world of professional wrestling, and we said in wrestling there's always a bad guy and then there's a good guy. And then sometimes the bad guy, like for example The Rock, he was a professional wrestler, he was so popular that people said, we want him to be the good guy. Mm-hmm. And I think, in the international monetary system, this heel turn is kind of happening. So gold has been, something that was not really respected globally for the last 30, 40 years. And now it is becoming a neutral monetary reserve asset. Why? Because starting in 2022, with the sanctions against Russia, we're seeing that central banks are picking up almost 30% of gold production every year, so more than 1,000 tons of gold. So emerging markets realized actually, okay, if they can sanction Russian FX reserves, 400 billion, they can do the same with us. So you want to own a physical currency, physical money without any counterparty risk that is traded 24/7, which has a very sophisticated infrastructure, low bid-ask spreads, and that's actually gold. So those are, I think, the major things that have changed in the gold market.
Thanks, Ronnie. Sean, just turning to you. In the current context, with global polarizations, there's sanctions on like U.S. assets and currency, or assets and access to U.S. currencies. Do you think there will be a return to the gold as a reserve currency?
Well, I live in Canada, which is now experiencing significant inflation due to a discounted currency. So we're seeing it in real time in Canada with the currency now below 70 cents. We're seeing, when we look at gold as a commodity, compared to every other commodity like copper, nickel, zinc, gold has gone up 4x comparative gain. It's in the last 10 years. That is telling us that the market wants more gold. That is telling us that this is a highly in demand metal. And the reason that is because it is the only real money, and everything is still measured against it. There's, as Frank and I were talking earlier, there's some real world tokenization, because now the people that have crypto don't really have anything to buy with it. More and more countries are trying that experiment. There's about $750 billion worth of cryptocurrency in trade right now that's sort of competing with the US dollar in a small way in small countries like El Salvador and other places where they've given up on their domestic fiat currency and they've switched over to crypto. The other countries that can't trade in US dollars, Russia and China, that are going on to that trade. We're seeing heavy demand for that, and the de-dollarization that Frank touched on and Ron at the start. That trade is here to stay. The world is bifurcated into those who want to have a US dollar as a reserve currency and all the rest. On the mining side, supply has become extremely difficult, access to territory difficult. So there's a constraint play on their supply side as well. On average, we surface about 1.4% more gold every year of mining for the last couple hundred years. That's the key to the gold trade, is because that constraint is what makes it go up in value. We have never been able to really beat that number, and it's become more difficult as more and more countries get more bureaucratic. Permitting timelines are like 14, 15 years on average now. A lot of mines are played out. The near surface stuff, the mines of Frank and my generations are mining out now. All the stuff that we did in our 30s and 40s is played out. So the cost of exploration has gone through the roof because now you're drilling blind targets. So that squeeze on supply is real and here to stay. And the competition to the gold currency, with questions around the dollar and the U.S. empire status around the world and the dominant economy, is now in question again. So I see this gold trade as, the $3,000 to $4,000 that Goldman Sachs and JP Morgan have been talking about is a real thing at this point in time. And you see Donald Trump being very friendly to crypto right now. He's speaking at every crypto conference that he can get to. He wants to control that crypto trade because he doesn't need the competition to come from there. It's almost impossible to borrow against gold bullion. If you go to almost any Western bank and you have bullion and you say, hey, give me, I got $1 million worth of gold, give me $100, you can't get it. So that's been the bank's standard fare. They'll buy it for central bank, but you can't borrow against it. With crypto and the real world asset transition, the first asset that got tokenized as a real world asset was $1 billion worth of gold. So this trade is getting stronger.
So before I turn the spotlight to Andre, I just want to come back to a point you made, Frank, about the kind of Eastern world, like emerging market that has that appetite for gold. How do you see the US reacting to it?
I think it's going to be a very forceful reaction and potentially a violent reaction. You have to understand that the reserve status of the US dollar will become a national security issue. And the reason is, there are a number of reasons, because if it loses a reserve status through this de-dollarization movement or a movement towards gold or anything else, or any other mechanism, a number of things happen. You're going to get higher interest rates, higher inflation, lower standard of living, and most importantly, the U.S. will lose grip on the global financial system, which it now controls, and lose power, won't be able to do the sanctions. So to me, it's a very, very serious issue. And I've been talking about this for a long time and saying that this is happening, and there was a lot of denial and being ridiculed that it can't happen because of TINA. There is no other alternative, or where they're going to go. The U.S. dollar, there's nowhere else to go. And I've been talking about this for years now. And the fact is that, and then suddenly they started to pay attention, and you started to see these veiled threats against Turkey and the UAE for using non-dollar mechanisms to avoid sanctions. And it took Trump to come out and just say it plainly. And he did this last week and said, any country that doesn't commit to staying within the US dollar system, I will impose 100% tariffs on. To me, that told you that they now recognize it is a serious problem, it's a threat, I think what he's saying is going to backfire if they try and do that. It's just going to accelerate de-dollarization. Even if they could get commitments from any of the BRICS countries that they wouldn't, which I don't think they will get any commitments, they can't stop central banks from selling their treasuries and from buying gold. And you're seeing the dumping of treasuries now. You know, China has been dumping, they're down to $730 billion worth of, they were at about 1.2 trillion. And even Japan, which has been steadfast in holding, sold $60 billion in the third quarter. So I think that, that this is going to be real, and the U.S. is not going to like it. And they will do everything in their power, and it's going to get ugly. I really think it's going to get ugly.
Andrei, I'm not sure if it's a blessing or a curse to have all the speakers going before you, but they did answer some of your questions or touched upon. But do you see a difference in perception between the West and the East? And do you see a greater appetite in emerging market for gold?
I mean, the question is quite complex because you need to look at various components of gold demand, both in the West and the East. I think I'll agree with some esteemed guest speakers here that, you know, the key driver in the East, and actually globally, has been Chinese central bank buying. They were the biggest single buyer in 2023. Currently, as a total percentage of their reserves, gold is about 5.7%, which, you know, you look at, you know, US, France, it's over 65%. So, you know, there still is a lot of buying to come from the Chinese central bank as, you know, they seek to diversify you know, their reserves from the US dollar, given the weaponization of US dollar. And even though, you know, in the first 6 months, the kind of buying has stopped from the ETF investors in China has picked up the slack. It's been a big growth area. You know, I don't pretend to know the kind of reasoning behind the thinking of Chinese institutional investors, but don't quote me on this. I think it was $11 billion worth of demand this year came from Chinese ETFs, but this is in the background of demand for physical gold in China from retail investors is actually weakening by 6% this year. But it's just, you know, the demand from Chinese investors, central bank, has been quite overwhelming. I think if you look at the West, again, you know, when you're looking at sort of the fast speculative money, you look at the COMEX positions, which indicate kind of short-term investment demand. I mean, they've been net long all year. That shows that, you know, kind of the short-term investors are bullish on gold. ETF demand for gold via ETFs has strengthened this year after being quite weak for a couple of years. So, you know, what I see is kind of overwhelming positive demand in the East and the West this year, and hence, you know, the gold price has been driven to all-time highs. I think a lot of the trends are positive, and we're going to see strong demand in the East and in the West for years to come, as long as the geopolitical situation doesn't change, which I don't see.
Right. And Ronnie, going back to Trump, Trump says, and I'll quote, "I'm the king of debt. I'm great with debt. Nobody knows debt better than me." What impact do you think President Trump will have on gold once he's in office? Do you think it will provide like a positive environment for gold?
I think it's a little bit overrated, the impact that Donald Trump has on the gold market itself. I mean, many people think that Donald Trump will actually take care of all the problems in the world that we have. I'm slightly pessimistic, yeah. So, I mean, it's at least it's going to be very interesting over the next couple of years, and I think that the team that he has put together is, I mean, there's some really interesting characters in that team. But, you know, if we compare the first term of Donald Trump, what gold did, actually it was when he won the election, gold was selling down big time, and I think gold made its bottom on December 12th. And then during his term, gold was up 67%. So that was, on surface, pretty positive. However, on the other hand, I think it's important to say that when he came into office in 2016, inflation was no concern at all. Now I think Trump really understands what the median voter really wants. And inflation was definitely the biggest concern, inflation and immigration. Second thing is that back then bond yields were still pretty low. Now Stanley Druckenmiller just recently said, and he's one of the smartest guys out there, the biggest threat that he sees is the loss of faith and trust in the US debt market. And now we're trading 10 years are at 420, 430. So that's definitely a big difference. So to put it in a nutshell, I would say that we shouldn't really overestimate the impact that Donald Trump has on the gold market. I don't think that he will really, that's, the Doge kind of ministry that Elon Musk and Vivek will be heading, that they will really be able to slash the deficits and to really cut costs. It's just not that easy. I think that Elon Musk won't stay around for too long, because if you for example, compare it to Steve Bannon, who was like really the most important guy for Donald Trump back then. After a while, when Trump realized that actually Steve Bannon is kind of stealing some spotlight and attention from Donald Trump, he got sacked. So I could see something similar happening with Elon Musk. So again, I think the fundamental drivers for gold are very, very strong. What has been a factor, and that's just the last thing on Donald Trump, I think the kind of the war premium that we've seen in the price of gold, I don't know if that's $200 or $300 US, you can't really put a price tag on it, but I think that has been priced out. I don't think that Trump can end the Russia-Ukraine war within a day, but I think we are getting closer to a solution, and therefore I would say that this war premium is something that is kind of being priced out of the gold market at the moment.
Frank, I hate to give away your age, but you have more than 45 years of experience in the industry. You've seen numerous cycles. You wrote several papers. Where do you see gold going, and what factors do you think will propel it, if any?
Okay, well, first of all, and I get asked this all the time, I never, ever predict the gold price. I think that's a fool's errand, because you'll end up looking like an idiot, because you'll never get it right, you'll never get the timing right. But that said, let me phrase it this way, and this is, I use this with people because to understand where gold could go, you just have to look at the past. So pretend now for a moment, it's 1971, and I'm sitting here on stage, and I'm saying to you guys, listen, over the next 10 years, gold's going to go up 27-fold. You would have laughed. It would have been ridiculous, but it did that, exactly that. Now pretend it's 2001, and I'm sitting here and I say to you, in the next 10 years, gold's going to go up 8-fold. You would have laughed, you rolled your eyes, what have you. So the third, as I see the gold market, because I've been watching this for a long time, this is the third phase of the gold market that started in 1971. We had the 71, then the 2001, it started again, and I think it's the third phase started when gold broke 1900 a while back, last year, whenever it was. Where it can go, pick a number, because what you have to understand about gold, what most people don't understand about gold, is that it's not gold that's going up. It's the fiat currencies that are measured against it that are losing value. That's what's really happening. Gold is the constant, much like in general relativity, the speed of light is the constant, and you have space and time where kind of, you can move those around. And so gold to me is the whistleblower on a failing fiat currency system. And so that's where, that to me is going to be the long-term driver of gold and where it's going to go. And I think when you say, what are some other factors that will impact the gold price, I don't know if you're aware, but the World Gold Council has been working for the last 5 years with the LBMA, 20 billion banks in the LBMA, to create digital gold. And I just had a recent conversation with the CEO of the World Gold Council, David Tate, and he said that 2025 will be the year where they lay the infrastructure, the fiber optics, to make gold settlement transparent and instantaneous. Right now, it can take up to 6 hours to settle a gold trade. And that's why, although the BIS, the Bank of International Settlements, considers gold a tier 1 asset, Banks don't, because their risk managers won't allow it because there wasn't any real data on volatility prior to 2018. They didn't keep it. And so once this is in place, you'll be able to trade gold anywhere in the world instantaneously. It's divisible. I think what they're aiming for is 1/100th of a gram. So it'll trade like cryptos trade. And this is what you're going to need to convince the TikTok generation to invest in gold. You're going to have to make it technologically convenient. And this will do it. So they're planning on launching this in 2026. So 2025, laying the groundwork. And the banks are currently, I don't know who mentioned it, was Ronnie or Sean, the banks can't get, if they use gold as collateral, even the LBMA banks, 85% discount. So they'll be able to get a tier 1 treatment of the gold as collateral. The banks are going to love it. So I think that's going to be a huge driver to get the new generation investing in gold.
Speaking of investment, Sean, what sentiment do you see investors towards gold? I mean, it doesn't seem like it received enthusiasm despite all-time high.
I mean, to follow on with Frank's comments and the World Gold Council work, getting the next generation of people, the TikTok generation per se, to actually understand and value gold as part of their ecosystem. The real world asset tokenization thing I think is important. Frank and I were both invested in an exchange that, for us, it's an experiment and an education to see whether young people are going to do this or not. And that ease of use that you can do all this off your phone while you're having a Starbucks, it doesn't exist right now. Gold is still cumbersome. You can buy the ETF, but to actually have something tangible. And I think that this generation hasn't really seen what happens in a big economic crisis. Last one was 2008, but it was more their parents that were in trouble. That crisis is probably going to galvanize this generation into understanding tangible assets. The access to tangible assets has been something that the U.S. government has gone to great lengths to avoid. If you look at Nixon banning gold trade and expropriation of gold throughout history, and a gram of gold is still a good measure, I think, because if you look at a gram of gold 1,000 years ago, it didn't have a lot of value. 100 years ago, you could feed your family and have a good time for a day, buy a chicken and a good bottle of whiskey, and still have money left over. Today, a gram of gold's worth $80 US. You get a bottle of whiskey and a good chicken, and you're still okay. If you have Deutschmarks or French francs in your back pocket, you don't have anything. And those have happened in most people's lifetime that are in this room. All those things went to zero value. If the euro and as Frank said, I mean, this is a devaluation discussion. Gold has been constant. What you could buy with a gram of gold 100 years ago is about what you can buy now. So that's not true for any other commodity, and certainly not true for any fiat currency. So this race for devaluation and getting this generation to understand the devaluation war that they're in, which is affecting their life and their ability to buy a house or even conceive buying one. I think Trump's effect is going to be, this is a tariff sheriff, right? He's got, Howard from Cantor Fitzgerald has come in. He's explained tariffs and how many economies, like the European economy, is protected by tariffs. The reason there's no U.S. cars in Europe is because there's a tariff on U.S. cars to Europe. If he starts to peel back these tariffs, it's going to be inflationary around the world in terms of economies like China not having access to the U.S. consumer, which is his biggest power, is control of that consumer. And that access to that consumer is the stick that he's chosen to use here. And the only way to sort of hedge against that right now, I think, is through the gold currency. Rather buy the U.S. dollar, you buy gold.
Andre, we won't predict gold prices, but in the current context and hearing what everyone's saying about indebtedness of countries, devaluation of fiat currencies, why have we not seen the prices of gold higher?
No, my personal opinion, gold is such a unique commodity that's really, its value is driven by collective perception of the value of fiat currencies. So I think, every day that, we wake up, the gold price is correct. So, today we've got the right prices, and tomorrow, whatever price is, it's the right price. And so the price will move based on, change in collective perception of, the worth of other currencies, primarily fiat currencies. I guess now you may want to add like cryptocurrency to that, Bitcoin, but, for me, the gold price is at a correct level. So yeah, quite a simple answer.
Okay, no, that's good. That's good. We need simple answers sometimes. Ronnie, just to be a bit more practical, in terms of portfolio diversification, what are your suggestions for investor when it comes to gold or their derivatives, such as ETFs, for example? I've heard you, and I can't quote you on this one, but using kind of metrics of 10% physical gold and then X percentage of ETFs or derivatives. So what are your takes on that?
Yeah, well, we put out a paper about the optimal gold allocation. So we actually read all the academic papers and then crunched the numbers on our own, and we said, so the conclusion of that paper was that actually 14 to 18% gold is like really improves your Sharpe ratio in a typical equity bond portfolio. So 14 to 18% roughly. Now, if I say that, talking to a Western institutional player, for example, they would say 14 to 18%. It's ridiculous. Yeah, that's way too high. 1 or 2% perhaps. Yeah. If I say that in Turkey, for example, I just did a keynote in Istanbul a while ago, and they've been asking like the most brilliant questions. Why? Because they understand gold. Because for them, with the Turkish lira being a pretty rubbish currency and inflation is like the main concern for portfolio construction, for them it's just obvious to own gold. So if I say 14 to 18% in Turkey, they would probably say, that's actually too low. So let's say around about 15%. And we're like the global wealth management industry is like 128 trillion US dollars, and the world is heavily underweighted in gold, obviously. And even though gold is up 30% this year, or let's say the purchasing power of most of the major currencies is down almost a third in 1 year, which is pretty dramatic, I would say. We still don't see too much of excitement, I would say, when it comes to gold. Most of the people say, actually, now the price is too high, I will wait for the correction. But I think it's important to really ask yourself, what is your motive? Why do you want to own gold? Are you hedging against worst case scenarios? Do you regard it as a hard currency, or do you regard it as speculation? So if you want, and we call the second thing, the speculation, we call it performance gold. And I think that gold and silver mining equities, also silver and commodities can be labeled performance gold. But I think the differentiation between performance and safety gold is that this performance gold really has to be actively timed. Let's have a look at charts of a mining index. You see those major moves and then drawdown 70-80%. That's just pretty common over a cycle. So I think physical gold it's just something that you basically inherit to your kids or grandchildren. Performance gold, mining equities, silver, really active timing is crucial, and that's what the job of a fund manager actually is.
Sean, what's the best way for investors to hold gold other than probably the physical gold?
Well, I'll start out with my constant line. I am a mining promoter, and I would assume that Frank and I are in the same club of mining promoter oriented, and I would say that the difference between a pessimist, an optimist, and a mining promoter is that a pessimist will see it half empty, the optimist half full. A good mining promoter will look at the same situation and say, listen, we're only at 50% capacity, and we have 100% upside. So on the mining promoter side of it, I would say that pure gold plays in good jurisdictions. The junior mining business has always had a kind of casino environment around it. It's certainly where I've had my biggest successes. If you're going to play mining junior stocks, which is mostly what we see on the floor out here, There's the strategy I always say is, you can bet the jockey or you can bet the horse, but if you bet a good jockey, normally a good jockey shows up at the Kentucky Derby on a fast horse. He doesn't show up on a donkey. So getting that combination judgment right of trying to find the management team and the asset together in a good jurisdiction and meeting your timeline horizons, because the time value of money in mining investments, the so-called Lassonde curve. Frank and I have the vintage that would have been the Ned Goodman curve, because he taught it to Lassonde. So that understanding where you are in the curve is important, and taking an opinion on a stock, and then educating yourself about that stock. Talk to management, and don't shotgun the thing. Choose a few and educate yourself on them, and try and choose things that are meeting your time horizon. If you need to get your money back in 3 to 6 months, exploration's probably not your friend. Development a little bit further along the food chain. And then sort of the mid-tier producers have had some pretty good gains. The bigger companies have struggled to increase value lately because of the cost of capital to replace their ounces, the number of jurisdictions that they're managing, the amount of historic liability that they're managing. We've seen a lot of the bigger companies have struggled to do that, and the polymetallics are a different game altogether. The one that obviously I have the most contact with is Agnico, because we sold them Canadian Malartic back in the day, and they've been one of the top performers in the gold space, mostly Canadian-based assets, bigger assets like Canadian Malartic and Detour. That's sort of your premium club. And then Frank and I are down there trying to build the next set of assets that Agnico's going to buy, right? So those are the ones that we would focus on. In terms of the outside stuff, the ETFs are always an easy liquidity one if you need liquidity. And I think that, depending on what currency you live in, most people that are buying gold right now are probably not living in US dollars. They're probably living in Canadian dollars or euros or something. Our Prime Minister got taken into the woodshed in Mar-a-Lago last week and told that they're going to get $100 billion worth of reprisal tariffs if they didn't get their game together, and that they would make him governor of the 51st state if he didn't play the game. So gold looks pretty good just about now.
So gentlemen, that was an interesting talk. Thank you so much. We have 7 minutes and 27 seconds. So I just want to make sure that the audience is able to answer some questions. So if anyone has some questions, just raise your hand and I'll try to point you. We have less than 7 minutes now. Lucas, yeah. Okay.
Hi, thanks all for your comments thus far. I've just got a question for Ronald in terms of portfolio allocation towards commodities. I was at an event a few weeks ago, and there was an asset manager there from, I believe, Legal & General, saying that I believe from the perspective of Sharpe ratio, the ideal allocation they find for commodities within clients' portfolios is about between 9 and 12%, which is significantly higher than sort of the standard portfolio allocation of 3, 4, 5%. So could you elaborate a bit further on what you think needs to be done within, let's say, Western countries and jurisdictions to, maybe from a compliance perspective or regulatory perspective, to persuade and encourage these portfolio managers and asset managers to increase portfolio allocations towards commodities on behalf of their clients? Thank you.
It's a great question. I think that if you crunch the numbers, commodities actually have the highest correlation with the momentum of inflation. So you could say that commodities are a pretty good inflation hedge. Now obviously, we've had like 40 years of falling inflation rates, the so-called Great Moderation. That was actually a time when this 60-40 portfolio was basically celebrating its best times because inflation wasn't a concern. We had a negative correlation between bonds and equities, which has completely reversed recently. Now, my take is that actually let's say the enemy of commodities and especially gold isn't the equity market, but rather the bond side. And yesterday I showed a new chart, which is like a 10-year CAGR of the inflation-adjusted performance of 10-year treasuries. And you can see that for 2.5 years now, we are seeing negative performance. And if you compare that to the 3 big previous bear markets in bonds, they took almost, I think, between 12 and 15 years. So we could say that we are actually at the beginning of a big bond bear market. Few people have realized that because everybody is going back to the old regime, basically saying, okay, inflation, that's over. Central banks did a tremendous job. They killed inflation. I would say, well, actually, they told us for quite a while that it's only temporary. It's just, Madame Lagarde said, it's a hump. They told us it's transitory. It's only happening because of energy prices. And therefore, I wouldn't overestimate the forecasting capabilities of central banks. And from my point of view, inflation will remain a major concern going forward. And therefore, I would say that the majority of the potential for commodities and also for gold will actually come from the bond market. And I think that people, again, 40 years of falling inflation rates, of rising bond prices, of a negative correlation between bonds and equities, I think most people are still in this old paradigm, in this old regime. There's very, very few active asset managers out there that actually manage portfolios in a time of high and volatile inflation. And I think that if that changes, for example, in the 1970s, it was pretty normal. There were actually some bond funds that held 20% physical gold in their portfolios. And therefore, I would say inflation and some sort of a rush out of the bond market, that would be the driver for commodities and gold.
I was intrigued, Ronnie, by your estimate of 14 to 18. I did a similar exercise for capital preservation for a multi-billionaire Asian family right at the beginning of the gold bull market, and came up by trial and error, not terribly scientifically because I'm a moron, with 20% as the key gold holding to guarantee the portfolio in aggregate would be intact in most scenarios. So it's very interesting validation. You've actually done the work and I've just done the guesswork. I'm intrigued also by your suggestion. To me, and I draw on another experience I had, was the end of the Japanese bull market. Obviously, Japanese stocks were fantastically expensive at the end of the Japanese bull market. What people forget is Japanese bonds yielded 7% at that point in an almost, very low inflation environment. My question, because it relates to where we are now, I think, which is, US stocks are incredibly expensive. What is the likely impact on gold of a major decline in US stocks? In Japan, we had a stock issue where stocks went down, people got poorer, but we then had a flow benefit into bonds from people not buying stocks. US stocks come down very sharply. Obviously, there's going to be a major impoverishment and potentially liquidity effects. Is that damaging to gold in the first instance, and then people turn to gold as the savior, as they did with bonds in Japan? Or is it people go straight to gold? It's a timing issue that I'm concerned about, that if we have a generalized risk-off market event, how does gold perform in that scenario in the shorter term and further out?
Well, if you have a look at the correlation between consumer sentiment and the S&P 500, it's extremely high. So therefore, I would say, the Federal Reserve obviously knows about that. Trump knows about that. So you actually really need a rising stock market to make the wealth effect and make the U.S. consumer feel well. Now that obviously necessarily doesn't mean that there cannot be any crash in U.S. equities anymore. But if we draw an analogy to 2008, 2009, for example, gold got hammered. We went from more than $1,000 US, I think, when was it? In March for the very first time when Bear Stearns went down. And the low was at 660, something like that. And then, you know, rates were lowered, QE, something really new was being introduced, and gold was the very first to make the bottom and started rising. And mining equities actually followed very, very soon after. So I would say if there's going to be a crash in US equities, and obviously, you know, valuations are pretty rich, but they're pretty rich for quite a while now, then it will have an impact on gold and probably more so on mining equities. But we also know what the reaction function is going to be. Rates will be lowered. We will see, I don't know if it's going to be called QE or whatever. But coming back to what we said at the very beginning, I think that the importance of the, let's say, the Western financial investor is lower than ever. And I think that really this marginal buyer being in emerging markets, I think we should focus much more on what's actually going on in China, what's going on in India, what are the numbers coming out of Turkey, of the Mideast. I think those numbers are becoming much more important for the development of the gold price than just the pure numbers coming out of the US and Western markets.
I think we now need to just finish this fantastic keynote gold panel session. So can we have a round of applause for our fantastic panel?